Recessions are often unpredictable. You don't know when jobs could be cut. Everyone is still recovering.
The globe is still recovering.
And now we have a war and an oil crisis. I filled up last night at $3.10 a litre. 3 weeks ago, I filled up at $1.80. That's going to be an extra $4,600 I need to pay a year. At a time of recession, is a bank going to allow everybody to go in there and do 100K and pull it out? They can say, no, we're going to put a halt on all redraw withdrawals.
I want to make sure that we are recession-proof. How do we do that?
Oh, Michael, there are so many things to help you battle a recession, but unfortunately...
Welcome back to the Finance Show with Joe. And today we're going to do something just a little different. No segments, no fluff. We're getting straight into it because the Australian economy is giving us some severe warning signs about our future. And Joe, I want to make sure that we are recession-proof. How do we do that?
Oh, Michael, there are so many things to help you battle a recession. Unfortunately, recessions are often unpredictable. You don't know where there's going to be a supply chain issue. Mm-hmm. You don't know when jobs could be cut.
Yeah.
And you also don't know if there's going to be any sort of deflationary practices or, changes to tax structures.
Yeah, because not every recession is the same either. Like
No.
they all come from different reasons. Like there was that oil crisis in the 70s. We had the GFC, which was a housing thing in
Sovereign
the
debt
US.
crisis.
Sovereign debt crisis.
COVID.
COVID. That was our last recession in Australia.
Correct.
It was a quick little 2-quarter recession.
Yeah. Well, I don't know if we actually went into a recessionary period during COVID. However, I'm talking about Australia particularly
Yeah.
because the government rolled out as much as it could to prevent us from going into a recession.
Yeah.
But I do know America got hit hard.
Way harder than us.
Yeah. Lots of Europe got hit hard. They're still recovering. Everyone is still recovering.
The globe is still recovering.
And now we have a war.
A new war.
And an oil crisis. In today's episode...
Yeah, we're not going to talk about that.
In today's episode, I want to base this on what you can do with your home loan to basically protect yourself.
Yeah, really
from
good
recession.
practical advice because honestly, there's not too much you can really do. Like recessions are bigger than any individual.
Correct.
Any government even. Like they can provide things to try and fix it, but that's it.
Yeah, that's correct. So we've come up with 5 things
Yep.
that if you do have a home loan or if you do have an investment loan, you can utilize or you can implement today. And now before we do go any further, I do want to note that the advice on this channel is general in nature. As should you need specific advice, please contact your financial advisor. In saying that, Michael, we've got 5 things to make you recession-proof when it comes to property.
Give me the good stuff.
Okay.
Give it
Now,
to me.
the first thing I want to discuss is stretching out your home loan.
Yeah.
Okay.
Standard home loan, 30 years, stretching it out. What are we talking about? Is this 40 years? Is this 35? Like, what does this mean?
I'm talking about people that have had their home loan for 5, 6, 7 years already. So let's say you bought in 2018 or 2019 and you've had a home for 7 years and your home loan is now down to 23 years remaining and you're making your principal and interest repayments. Now, there is, this episode isn't about how to pay your debt off sooner.
No.
This isn't about how to, maximize your property portfolio and I'm talking about just asset protection and protecting your cash flow.
Yeah, this is sheltering yourself from the eventual economic storm.
Yeah. So we've seen recently petrol has jumped up significantly. I filled up last night at $3.10 a litre. 3 weeks ago, I filled up at $1.80.
Remember when we thought that was expensive too?
That was expensive.
Yeah.
That was expensive, but $1.30 extra at the pump. I got a 60-litre tank. That's $90 extra, I think.
Diesel or petrol as well?
I'm diesel.
Diesel,
You know,
same. Yeah.
But I'm trying to, I bought a diesel so I don't have to burn as much, but now I'm paying more money. Anyways.
Yeah, that's another thing.
That's another thing. But I'm thinking to myself, if I was a simple salaried employee, I wasn't a business owner, this is now costing me an extra $90 a week. Okay. If this costs me an extra $90 a week or a fortnight, whatever.
Yeah, whatever it is.
Yep. Okay. That's going to be an extra $4,600 I need to pay a year.
Yeah.
in petrol.
Quick
If
maths.
the petrol stays at that price, 4,680 if I want to be specific. If the petrol stays at that price.
Yeah.
But if my wage doesn't change.
Is your purchasing power gone? Your cost of living pressures increase.
Correct. Now, with fuel, we also have to consider the cost of goods.
Yeah.
We also have to consider the cost of things like freight, imports. Things become more expensive.
With farmers as well, they need diesel to power their equipment.
Correct. So there is possibility, if we don't have a resolution soon, that this is going to be a permanent effect. So to protect myself, let's say I've had my loan for 23 years.
Yeah.
I will instead refinance and stretch it out to 30 years. So a good example of this is, let's say I've got $1 million loan and I've got 23 years remaining on my mortgage and it's 6% in interest.
Yeah.
Okay. I did my maths earlier in preparation for this show.
See, we don't just wing it.
So let's say I've got 23 years remaining on my loan. That means my monthly repayments are $7,226. If I refinance it back out to 30 years, my repayments drop down to $5,996. Have I added years to my mortgage? Yes.
Yeah, but you need the cash now.
Correct.
Yeah.
Okay, that's $1,300 extra a month. That is $15,000 in a year.
Yeah, and we just said that what $4,600 on just fuel alone if it stayed at this price. So there you go, you've shored up your fuel.
Correct. So the first thing I'm really looking at is the opportunity or the possibility of stretching out my loan.
Yeah, okay.
And I think people need to speak to a mortgage broker now, because one of the issues that we have in Australia is our inflation isn't only caused by the war.
No, there's a few things going into
There's a few things going into it. So there's potential for our interest rates to stay stubborn and at that higher amount than coming down, even if the war ended tomorrow. Because yet again, there are other inflationary pressures that are causing our interest rates to stay so high.
Yeah.
So after I look at that, now this episode is coming out before the budget, our May 2026 budget.
Yes.
So there could be changes to investment loans.
100%. Yeah, they're talking about, there's talk that there's big reform coming.
Correct.
Just talk though.
So, removing the capital gains tax discount, when we don't have to focus on that too much.
No.
They might remove negative gearing.
Yeah.
Or limit negative gearing.
Yeah, which if you are relying on that cash back at tax time, maybe you need to start rethinking your strategy.
Correct. However, for today's strategy, it still exists.
Yes,
so I'm going to include it.
Yeah. No, that's fair, because we don't know it's going to change. So let's not prepare for
So
nothing.
Step number 2 is possibly looking at interest-only loans.
Okay.
Now, the reason why I say interest-only loans is interest-only, you can offset the principal and your repayments are usually lower than what a principal and interest repayment will be.
Yeah.
Now, I could tell you firsthand, because I deal with mortgages every day, interest-only repayments are often at a higher rate. So a lot of the time people end up saying that, hey, wait, my repayments are pretty much the same. Why don't I switch to principal and interest? Haha, here's the beauty in it.
Yeah, okay.
If you have an investment property, and you instead utilize an interest-only account, 100% of your interest repayments can offset your tax liability. What does this mean? I've got $5,000 a month that I'm putting towards my mortgage. Okay, that's $5,000 interest only. My rental income is $3,000. That $24,000 is the cost of my property because that's the interest offset plus strata. I can utilize all of that up against my personal tax return.
Yeah.
And I can reduce the amount of tax that I pay every single year and possibly receive a higher tax benefit. So step number 2 is especially if I've got an investment property, I'm really looking at interest-only options. And I'm looking at these specifically because there is so much tax benefit.
Okay.
That is today. The May budget could blow this up and change everything.
That's true.
And I advise, if I'm going to offer any advice, I advise people speak to their mortgage broker today, because right now when we face a recession, the biggest thing that you've got to focus on
Yeah.
is asset protection and
Yeah.
cash flow protection.
Like cash flow. Yeah. Yeah, absolutely. Question for me, being of the ignorant, unwashed masses. How long do you have to, can you do this interest rate? Does it, obviously it has to be for at least one financial year, right? Or
Interest only?
yeah, interest only.
So interest only, as long as you don't fix your rate, which we'll get into later, but as long as you don't fix it, you can switch in between the products. However, they often only, each lender is different. It's often 1 to 5 years. Now, Westpac has recently brought out a 15-year interest-only loan. AMP has their 10-year product.
I'm sure somebody knows. It's not me.
The issue with interest-only loans, however, is you still got the principal portion of it.
Yeah.
You still need to prove that you could pay off the principal in the amount of time that you've taken off the regular mortgage. So if I've got a 15-year interest-only loan with Westpac, that means I need to pay off the principal and interest in 15 years.
Yeah. So if it's $1 million and you got to pay $1 million in 15 years. So
And that's a lot more.
that's a lot more than 30 years.
That's a lot.
Like a lot more money in a short amount of time. Yeah.
So that means you need a higher wage. So speak to your mortgage broker before you go and apply for any of these loans.
yeah.
Don't go direct to the bank. And the reason why I say don't go direct to the bank, a lot of people don't know this. A bank will instantly submit your application in hope that it'll get approved. A mortgage broker, a good mortgage broker,
Yeah.
won't submit an application unless they know
It's going to get approved.
it's going to get approved. So that's why I say speak to a mortgage broker first before you speak to a lender, because the mortgage broker might also look at your personal situation and say, hold on a second, you're not good for a 15-year interest-only loan because you're going to retire in 5 years.
Yeah.
How can I ensure that in 10 years' time you're going to be able to repay that?
Yeah.
Or another option is, oh, you're working casually, but you're a teacher. You're not suitable to this bank because they'll only take 80% of your income, but you're suitable to this bank because they'll take 100% of your income.
Exactly. Okay.
So don't do it yourself. Go to an expert, an actual expert, somebody that's been in the industry for a while.
Yeah.
But-
Look at the testimonials. Look at the case studies.
Yeah.
You know, do your due diligence.
Do your DD, but make sure you're out there trying to protect yourself.
Yeah.
And the best way to protect yourself, I gave you reason number one, stretch out your mortgage. Try and stretch your mortgage, okay? Not everybody can be applicable, but try and stretch your mortgage. Number two, if you have an investment property, switch to interest only.
Okay.
I don't often advise people with owner-occupied properties
To do that.
to do that. The reason why is the interest is not tax deductible.
Because it's not an investment. That's the only time negative gearing applies.
Correct.
Yeah.
And the second reason why is the interest rates are higher on interest-only loans. So if you switch your owner-occupied property to an interest-only home loan and the repayments are just a little bit, maybe just a little bit less, are you really benefiting? You're not.
No, you're not, because the whole thing, like, you want to bring down the principal, especially if it's your owner occupied.
Yeah. Correct. The next thing, utilize your offset account.
Oh yeah. This is something I need to get better at. But again, as cost of living pressures get tighter, it's hard to just put money into the offset account, well, at least for me as well, because I got to share it with 3 other people. So
Correct.
that makes it difficult to actually put money in and go, who's this? What?
Yeah. So with your offset account, your offset brings down the amount of interest that you are required to pay on each repayment. Now, the offset account and your home loan interest are calculated daily by the bank. This is how they make money, the extra cents, the extra dollars, all that sort of stuff. But let's say I've got $10,000 over here in my offset account. And my home loan is $600,000.
Yeah.
As opposed to me paying $600,000 in principal and interest, I'm paying $590,000 in principal and interest.
Yeah.
Now, people often hear, no, you should just make the extra repayments, make the extra repayments, make the extra repayments. That's making the extra repayments is good on owner-occupied principal place of residence type properties. But when it comes to investment properties, you might be better off utilizing an offset.
Makes sense.
Another thing is when people say, don't use the offset, don't apply for an offset account, go just get yourself a redraw facility. When you're paying into a redraw, you're technically paying more of your loan off.
Okay.
And even if your mortgage has unlimited redraw,
Mm.
at a time of recession, is bank going to allow everybody to go in there and dip 100K and pull it out? They can say, no, we're going to put a halt on all redraw withdrawals. So you need to understand the economics of it. I could tell you now, big banks are happy to cop a fine if it means protecting their share price and their shareholders.
Yeah, I mean, they've got the cash. They can pay the fine.
Correct. But they are more interested. If they say we're shutting down redraws, then ASIC has to do a massive investigation.
Yeah.
3 years down the line, okay, we found that you weren't letting people utilize their redraw accounts correctly. We're going to fine you $100 million. Okay, we're happy to wear that $100 million fine if that means we protected our bank and we didn't go $1 billion into debt because everybody tapped into their redraw.
Yeah. 100 million or billion, you
Correct.
know, it's not hard to pick one there.
They often weigh it up. And I'm not saying that I've been in that room, but we've often heard that banks are happy to pay the fine if it means protecting their share price and their shareholders and the big execs bonuses. So don't go into, oh, I'm just going to use redraw. I'm just going to use redraw. Speak to your mortgage broker.
Yeah.
Actually understand the difference between an offset account and a redraw account, because an offset account, no matter what, a bank can't say you can't take out of your offset.
Yeah, because that's just like, well, it's yours.
Yeah.
Yeah.
That's a bank account. Redraw, yeah, that's a little bit different. Number 4. This is one you're going to have to help me with. Audit and cut unnecessary expenses. This is a self-audit.
Yeah, this is, you have to take like, you'll be essentially, you got to look at your finances, look at your statements, and just see what you're spending is how you want to live your life, right?
Correct.
This is what you want to spend your money on. You're happy doing it, whether it's smoking, streaming, food, drink, anything that's fun and good. You're just gonna have to make sacrifices. It's just straight fact of the matter here. Maybe instead of having 3 streaming services, you pick one. Go one at a time each month. Pick a show. We're doing this for this month. Cancel it. Go to the next one. You could do something like that. Catch public transport to work. That's an easy one.
I'm going to go one step further. Guys, everybody's got access to Microsoft Excel.
Yeah. Pop it in there.
Pop your expenses in and see what you can reduce.
Especially if you're like, honestly, a huge one as well. And if this is an option for you, go to Aldi instead of Woolies or Coles. Like Coles is literally in court right now for price gouging. So
are they?
Yeah, they got done. It was proved that their specials were not specials.
Yep. I actually did not know that. So yet again, anyways.
Yeah. So do little things like that. I know like outside, if you're doing your snacks and your food, don't buy name brand stuff. If it depends, obviously, like shapes. If you like shapes, buy the shapes. It's all right. But if there is a cheaper alternative, at least in the short term, go with that. All these little things will add up over time. You don't even realize.
They do. I'm going to go another step further than you. So we've got discretionary expenses.
Yes.
Then we've got plug them into an Excel spreadsheet. But another thing is look at your subscriptions or your annual costs.
Oh, yeah.
Insurance. Your insurance premiums are going up again May 1st or April 1st. Okay. Insurance premiums go up all the time. You will often find a better deal out there if you go online and look for it, especially when it comes to health insurance or building and home insurance, home and contents insurance. Make sure you've got the right insurance. Make sure you're not underinsured. Make sure that you're taking care of yourself. But always make sure that you're looking at those annual repayments. And why do I say this? Because if you're subscribed to an insurance provider and they can just tick up the annual.
Which they do. They just send you the receipt.
Correct. And it happens to everyone. It's not a one-off. This is just no, this is how these companies make money, by increasing your premiums without you even knowing it. So have a shop around, especially right now, especially just before the annual repayments go up, and especially just before anything. Don't wait until it's too late.
No.
That's where I'm going with this. So,
be proactive.
Be proactive. Yes, correct. Okay. Especially right now, everybody's got an hour. Get off TikTok.
Oh,
Okay.
just put the phone down.
Just put the phone down.
Just put it down.
Just for 1 hour. Just sit behind your computer and find out what's coming out of your bank account, what you can actually minimize.
Yeah.
That's super important.
Mm-hmm.
Last item, and you know this, I know this, we've been doing this forever, but lock or fix a portion of your home loan. When I say fixed rates, okay, I don't like to fix an entire amount. I'm never going to advocate for fixing your entire home loan for 5 years, and that's the rate for 5 years, unless, you know, it was COVID times and it was 1.8%.
Yeah, that's
You know,
you take it.
you take that every day. But right now, what do we see? We see home loan rates around, let's say 6.09% just for a regular home loan, standard home loan. The fixed rates are higher than what they currently are. Okay, than what the variable rate is, because banks are betting on the fact that the variable rate's going to go up and up. So they offer the fixed rate at a higher amount.
Yeah, because they're still covering themselves at the end of the day.
But we also don't know if petrol's going to keep going up. We don't know if groceries are going to keep going up. We don't know what we don't know.
Yeah, we can't predict the future.
So keep a portion of your home on a fixed rate, because at least you know
some stability.
There is some stability in your life. I don't know what petrol's going to cost tomorrow, but at least I know 30% of my home loan is going to cost this much. At least I know 40% of my home loan is going to cost this much.
And it makes it easier to budget in that Excel spreadsheet that we were talking about earlier.
Correct.
I think a fixed rate is very good for someone who needs to budget and needs like clear, structured. I need to know how much is going out of my account every month, because especially if you've got kids and you need to make sure you got to tuition feed them, clothe them, all the good stuff.
Correct. But there's one thing about fixed rates that a lot of people don't tell you. With a fixed rate, they're not always 100% offset.
Okay.
So you need to be careful with your fixed rate as well. That's why we tell people fix a portion of your loan, because then your offset account can offset the variable portion of your loan. And also check with your bank, what's the maximum in repayments I can make on a fixed rate loan, because banks also cap the maximum extra repayments you can make towards it. So from memory, a lot of the banks cap it out $15,000 extra per year. Now, not everybody's got $15,000 to contribute extra. Okay, but let's say you've got a great fixed rate, and then home loan rates go up to, I don't know, 9%.
Yeah.
I'm talking about the overnight cash rate's gone up to 6%, and people are paying 9% interest on $1 million loans, and you've got a 6% fixed loan. All of a sudden your salary's gone up and you want to make extra payments. You can't.
Oh, you can't?
No, you can't make more than the set amount written in your loan contract. So always understand when you're fixing your home loan rate that, number one, double check that your offset account is actually offsetting the fixed rate loan, because chances are it's not. And number two, if you're going to make extra repayments, make sure that you understand what's the most you can make every single year.
Yeah.
Those are two very, very important things. And I think by conveying that message, people will have a better grasp or a better understanding of what the difference between fixing a rate and then expecting to, I got an inheritance, I'm just going to go pay. No, it doesn't work that way. It doesn't work that way. So you got to be very, very careful with your fixed rate loan as well.
Yeah. Okay. Well, that makes sense. Okay. So to sum up, essentially, fixed rate loan, the purpose isn't to help you pay off your home loan faster. It's to provide the same payments throughout a set period of time.
Correct. And during a recession, what's everybody looking for? Stability. And having just that one piece of stability, it does help a lot.
Oh, yeah.
So to summarize, number one, if you do have a home loan, and you do need the extra cash flow and you're trying to protect your asset, make sure you don't lose it or anything, stretch your loan. Look at those options, because stretching a loan is a very powerful thing. If you could save yourself $1,300, $1,400 a month, over a year that compounds. Remember, your home loan is not paid by your annual salary before your tax. It's paid by the money that you have after your tax. Number two, if you do have an investment property, I don't like to offer this to people with owner-occupied properties. You can look at the options. We will look at it for you, but interest only on investment loans. And the reason is you can possibly look at the negative gearing benefits for now and take advantage of those. Now, I will always add, speak to an accountant before you go and make the switch. And because I'm not an accountant, I can help you get the mortgage. I can help you get the debt. I can't help you with filing your tax returns. So make sure you speak to your accountant before you apply for an interest-only loan on an investment property to see if you can take advantage of the negative gearing benefits. Number 3, utilizing your offset account. Now, we've given the reasons why we like people utilizing their offset accounts. We just stated, hey, when you pay into redraw, I understand your lender said previously, oh, we'll give you unlimited redraw. There's a possibility that they could turn around and say, shit, we just lost $1 billion in China. Nah, we're not letting people do unlimited redraw.
Yeah,
because the banks trade internationally.
Yeah. And it's the global economy that is facing like contraction.
Damn straight of Hormuz. Number 4, audit your accounts, audit your spending habits, and look at your subscription models. I'm not just talking about Netflix. I'm not talking about Amazon. I'm not talking about Disney Plus. I'm talking about your insurance. I'm talking about health insurance. I'm talking about your cars. I'm talking about any annual registrations that you need, anything like that. Shop around if you can and see what you can reduce. I know for a fact, because I've recently bought a new phone, that they don't have locked-in plans anymore.
Oh, really?
Well, that's what I have with Telstra.
Okay, yeah.
But I, for instance, am on the higher tier. Yeah, guys, I'm a busy person. I need the higher tier. I need to pay $150 a month. However, if at any point in time I start realizing, oh shit, I can't drive to work because petrol's $3.20 a liter, and I'm not too sure if our listeners know this, but I don't have a train station near me. I can't get to work.
There's no train station down south.
No. But essentially, if I'm working from home, maybe I don't need as much data.
Yeah.
And because I'm in that particular plan with Telstra, I can reduce back down to the $60 plan and just use my home Wi-Fi from there.
Little tip as well, guys. The Aldi plans, the prepaid plans, super cheap. All the data rolls over, $28 a month.
We're not sponsored by Aldi, but we should be.
Oh, honestly, if you want to save money.
And then lastly is lock in a portion of your loan if you can. Speak to a mortgage broker beforehand. How many fucking disclaimers do I need to put in? Anyways.
Half this episode is just disclaimers.
But you need to give disclaimers.
That's true, yeah.
Consider, I'm going to use the word consider locking a portion of your loan to a fixed rate. So at least you have some sort of stability in your life.
Yeah.
Okay. 60%, 70%, 80% of your, I don't know. I'm not there taking care of your loan.
Get in contact with someone.
Get in contact with someone. Get in touch with a broker. Let them look at your scenario or your particular situation before you go and roll anything like this out.
And don't wait until the news is telling you it's a recession. Do it now.
Yeah. Pre-prepare.
Pre-plan.
Yeah. So,
because if they're telling you we're in a recession, okay, now you're going to have to rush all these things.
Well, not only that, if they start telling you now we're in a recession, buddy, we're in a recession like 6 weeks ago.
Right. Yeah. Exactly. It's on the news.
They just didn't want everybody to panic 6 weeks ago.
That's
but
true.
Now they have to panic.
Yeah.
I know we've got some oil fucking rigs coming in. I know Albo's done some back end deal with Trumpy over it, like for some.
Yeah.
things.
Like there's things are happening, but we you can only take care of yourself and your family, obviously.
And if I could just leave with one more thing. This war's fucking dumb.
It's so dumb, man.
Like
the more and more I just don't get it. I don't understand what the goals are anymore.
It's just fucking dumb.
It's so dumb.
It's like I'm sitting here filling up I had to drive 15 minutes to find petrol last night.
Really?
Yes.
Fuck.
I'm not kidding. So Illawong went to Menai. Menai didn't have any. So I had to drive to Padstow.
It would be worse in your area because there's no stations.
There's nothing.
There's no station. Like, not petrol station, train stations.
So get to Padstow, find somewhere, and I have to pay $3.10 a litre.
That's crazy. I've been lucky recently. My 7-Eleven up the road from me is not run out of anything yet. It's expensive, but it's not run out yet.
But anyways, guys, if you liked any of the tips that you heard or you want to hear more from us, you can reach out to us at itsimple.com.au. We can help with all the things that we stated except for auditing, and that's
on you.
We can help you with your mortgage, all right? But
we can refer a good accountant.
Well done. No, that was a great sentence. But yeah, thank you so much for listening. I've been Joe. That's been Michael. And we'll catch you on the next episode of The Finance Show with Joe.
See you guys.